2024 was a year of both strong gains and unexpected developments in Japan's markets. My strategy delivered over 30% returns, outperforming the Topix index by more than 10%. What were the key drivers behind this performance? Throughout 2024, Japan's financial markets experienced significant fluctuations. The year began with a strong rally, with the market up 18% through June, reaching 33-year highs. This rally marked Japan's new era after breaking through previous peaks established in 1989. A significant catalyst for this growth was the Tokyo Stock Exchange's initiative to name and shame companies with less than 1x book, announced in March 2023. This initiative instilled urgency in corporate boardrooms to improve returns on capital, leading to an acceleration of shareholder campaigns driven by both overseas and domestic activist firms. My portfolio saw standout contributions from several key holdings: Seven & I Holdings, Sompo Holdings, and Recruit Holdings delivered a robust performance, reflecting their strong market positions and strategic initiatives. SPARX was another notable performer, benefiting from its diversified business model and well-executed investments aligned with Japan's evolving economic landscape. Conversely, some companies struggled throughout the year. Mitsubishi Corporation, Japan's largest trading company, had a strong start but struggled later into the year. Roto Pharmaceutical, a leading skincare cosmetics and OTC ophthalmic medicines producer, and Renesas Electronics faced headwinds that negatively impacted their performance. However, the tide turned dramatically in August 2024, when an unprecedented market sell-off occurred. Stock prices fell sharply due to the unwinding of speculative yen carry trades that had contributed to currency movement. This event raised concerns among global investors about Japan's market stability and led to increased volatility. In September 2024, Shigeru Ishiba's election as a Liberal Democratic Party leader briefly unsettled markets with his proposed tax hikes, which were swiftly retracted after investor backlash. Around the same time, China's large-scale stimulus diverted global investment flows away from Japan. Political uncertainty grew in October as the ruling coalition lost its lower house majority, raising concerns over legislative gridlock. This coincided with Donald Trump's return to the US presidency, adding trade policy concerns for Japanese companies. Out of my normal style, I engaged in selective discussions with both Seven & I and SPARX, two of my largest holdings, regarding their strategies for enhancing shareholder value. With Seven & I Holdings, the focus was on improving operational efficiency and expanding its footprint in the convenience store sector while addressing concerns about capital allocation. I had the opportunity to have a one-on-one meeting with Stephen Dacus, the chairman of the special committee, on September 18th, where I conveyed my expectations on what kind of outcome we would like to see as shareholders and what needs to happen should they choose to reject these proposals. Similarly, SPARX was recognized for its diversified business model and proactive approach to investment opportunities across various sectors. I emphasized SPARX's potential for growth through its financial services and infrastructure projects, which align well with Japan's evolving economic landscape. SPARX remains a high-conviction investment, trading below 1x book. My research suggests it is reported 1.5x book effectively translates to 1x when accounting for unrealized investment gains. Additionally, as its asset management business expands, valuation metrics should shift from price to book to price to earnings. As we look toward 2025, one critical question on global investors' minds is whether the case for Japan is truly over. My answer is clear. It is far from it. While I have historically expressed skepticism about Japan due to structural challenges such as deflation and rising government debt levels, I now see a more positive investment landscape emerging. One of the key drivers of Japan's transformation has been the steady improvement in corporate governance. While this trend began in 2014-2015, it has only recently garnered significant global attention, signaling a fundamental shift in how companies approach capital efficiency. Corporate Japan is embracing a more capitalistic ethos focused on capital efficiency, a significant change from previous decades. Looking ahead, I believe that corporate governance reforms will continue to progress regardless of economic or political changes. All political parties share common interests: ending deflation, boosting the economy, and managing inflation without overheating it. As we consider the investment outlook for 2025 and beyond, I remain optimistic about expected returns from Japanese equities over the next several years. A simple mathematical exercise suggests that double-digit compound annual returns are feasible if benign economic conditions persist. Corporate Japan is positioned for stable earnings growth in the mid-single digits, supported by both organic expansion and inflation-driven pricing adjustments. Shareholder returns remain strong. Japanese companies distributed around 20 trillion yen in dividends and repurchased approximately 17 trillion yen in shares in calendar 2024, highlighting their commitment to capital efficiency. Moreover, despite improvements in earnings quality, where return on equity has risen from mid-single digits to almost 10%, the market has not yet awarded higher valuations. Should price-to-earnings ratios rise from 15 to 20 times over the next 5 years, this would translate to an additional compound annual growth rate of approximately 5.9%, enhancing the already solid earnings growth prospects. While some may argue that a price-to-earnings ratio of 15 times is not cheap compared to other countries trading at lower valuations, several factors make Japanese equities compelling. Negative real interest rates tend to favor equities. Cash-rich balance sheets provide a margin of safety. Improving capital efficiency is still in its early stages, and Japan's geopolitical stability makes it an attractive choice for global investors. Putting it all together, we can summarize the return components as follows: 3 to 5% organic earnings per share growth through sales volume growth and improving sales mix. 2% additional growth in EPS to reflect sustainable inflation. 3% from total capital return yield, which includes 2% from dividends and 1% from share buybacks. 4 to 6% from changes in valuation multiples. Therefore, we can estimate a compound annual return exceeding 10% over the next several years. Even without any re-rating of the multiples, we would be seeing a high single-digit compounding. Another viewpoint worth highlighting is the supply and demand dynamics of Japanese stocks. Japan may not be a high-growth economy anymore, but there is abundant surplus wealth of over 2,200 trillion yen in household financial assets. As a country of savers, Japan has kept roughly half of this wealth in bank savings with near zero interest for decades. However, with inflation becoming more prevalent, households are faced with continued erosion of their purchasing power. If Japanese consumers begin reallocating their savings into equities rather than keeping them stagnant in savings accounts, we could witness substantial capital inflows into the stock market. With a 10 basis point increase in base rate, this significant cash hoard will be set to increase by approximately 1 trillion yen, or 0.17% of GDP, again increasing the spending power of Japanese consumers. Japan continues to present a compelling investment case. Despite some challenges, the ongoing structural improvements in corporate governance and capital efficiency lay the foundation for sustained long-term value creation. With our disciplined approach, we are confident in our ability to deliver superior results for our investors. Our long-term goal continues to exceed the benchmark returns over a long time horizon, and I strongly believe this can be achieved with our superior insights, an understanding of the Japanese market to select stocks that can allow us to achieve this for our investors.